Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. Last week, we looked at the concept of valuations and what they told us about the mindset of investors, their risk appetite, and the state of play in the equity markets. We concluded that some sectors and stocks have become distinctly overvalued and were therefore very vulnerable to corrections as and when sentiment towards them changed. This week, we are going to look at a metric that is often used to justify valuations. That metric is earnings. Listed U.S. companies typically report earnings every quarter, and right now we are in the midst of Q1 2021 earnings season. The omens look good, with 25% of the S&P 500 constituents having reported Q1 numbers thus far. 84% of those companies have reported a positive EPS, or earnings per share, surprise, and 77% have surprised to the upside on revenues as well. Revenues are also growing faster than usual at 2.9%, well above the 1% 5-year average growth rate. Earnings growth in the S&P 500 is running at an impressive plus 33.8%, according to data from FactSet.com. If that rate of earnings growth continues across the reporting season, it will be at its highest level for more than a decade. On top of that, S&P 500 stocks are beating earnings forecasts by an average of 23.6%, and that will be the highest beat rate on record if it can be sustained. What's more, of the 17 S&P 500 stocks that have offered forward guidance so far, 12 have been positive in their outlook and only 5 have had something negative to say. The positivity continues if we look at profit margins, and as things stand, the S&P 500 is on course to record a net profit margin of 11.6%, which, if it comes to fruition, will be the third highest quarterly net profit margin for the index since 2008, and will be above the 5-year average figure of 10.6%. Wall Street analysts believe that these higher profit margins can continue across the balance of 2021. Their consensus forecast for the remainder of the year is for net profit margins of 11.66%. There's a long way to go, of course, with the majority of S&P stocks still to report, but there is much to be positive about. The S&P 500 is currently trading on a price-earnings, or PE, ratio of 22.3 times above both its 5- and 10-year averages of 17.9 and 16 times, respectively. But with earnings beats and revenue and margin growth all coming in well above average in Q1 reporting so far, can we expect the index to move higher still? Well, last week Morgan Stanley published research that suggested that the economic recovery, both in the U.S. and further afield, will run hotter than has been anticipated. The investment bank expects global growth to continue to surprise to the upside, and the global economy to be back on and then ahead of its pre-COVID growth path by the end of the second quarter of this year. Dr. Ed Yardeni, a respected academic and president of Yardeni Research, has published notes which suggest that the S&P 500 index is actually looking undervalued relative to its current rates of growth, and both corporate and government bond yields. Now, this is not the orthodox view in the market. Far from it, in fact. However, Ed Yardeni's research is popular with institutional investors because his views and his approach to the markets are not mainstream, and because he often has something different to say. If Dr. Yardeni is right and the S&P 500 is grossly undervalued in the current climate, then we could be looking at a market that could rally to considerably higher levels than we have previously seen. This is a big if, of course, but the earnings data and economic forecasts do seem to support a bullish case for the market. Timing the market is notoriously difficult, but retail traders can watch and see what the smart money on Wall Street is doing over the balance of the Q1 earnings season. And if the earnings data continues to shine, then it may make the upside case for them. That's all we have time for this week. Please make sure you do your own due diligence before making any investment decisions.